Hi, I'm Jonathan Wild. In this video, we cover how to prepare closing entries. Now, when determining which accounts to close, we first have to figure out which accounts are temporary accounts and which are permanent accounts. Temporary accounts relate to one accounting period and include revenues, expenses, dividends, and the income summary account, which we'll talk about in a minute. Permanent accounts relate to one or more future accounting periods and include assets, liabilities, and equity accounts. Basically, any account we'd find on the balance sheet. Now, when we do closing entries, we only close out the temporary accounts. If we don't close these temporary accounts and reset them for the next period, we would, for example, have last year's revenue reported on this year's income statement. While that sounds great, we don't want that. So let's do an example using our adjusted trial balance. And we start by closing out our revenue accounts. In our example, we only have one revenue account and it has a credit balance of $14,000. To close out this account, we record a debit to advisory revenue for $14,000 and a credit to income summary for $14,000. We debit advisory revenue for $14,000 because this zeroes out the revenue account, so we begin the next accounting period with a clean slate. Now we also credit income summary. Income summary is a temporary account only used during this closing process. It basically is a temporary account used to put all revenues and expenses that eventually get closed out to equity, which you'll see in a minute. Next, we need to close out our expense accounts. To do that, we will credit wages expense for $5,100, credit insurance expense for $100, credit supplies expense for $900, and credit depreciation expense for $500. We credit each of these expense accounts because it zeroes them out and resets them for the next period. Now on the debit side of this entry, we debit income summary for $6,600, which is the total of all of our expenses. After this, the income summary T account contains a $14,000 credit and now a $6,600 debit. The difference between these two numbers is $7,400. Now, just a quick tip as you go through your homework and exams, this income summary will match the net income you report on the income statement. So if your income summary number after closing out revenues and expenses is different from net income reported on the income statement, you should go back and check your work. Next, we take that income summary account and close it to retained earnings. This is to move net income from that period over to equity. To do this, we debit income summary for $7,400 and credit retained earnings for $7,400. After that, income summary is reset to zero to start the next period. Last, we need to close out dividends. To do this, we debit retained earnings for $500 and credit dividends for $500. This resets dividends to zero and reduces equity for the money taken out of the business. After closing out and resetting all of our temporary accounts to zero, we take a look at what we have left on our trial balance. We should only have permanent accounts or accounts that we'd find on the balance sheet left over on the trial balance. And we call this the post-closing trial balance.